All right, so in this video, I'm going to introduce a little bit about the types of ratio analysis and some basic principles associated with ratio analysis. So to kind of clarify a little bit and kind of set the stage, a number by itself is actually relatively meaningless. So let me give you some context here. So for instance, if I specify that a firm had $10 billion of profit last year, that sounds impressive. Is it good? Is it bad? And I would argue the answer is I don't know. It depends on the context here. And if they had $10 billion of profit when they had only invested, say, $20 billion, well, I mean, that sounded pretty impressive. And if sales were $100 billion, they had $10 billion of profit. Well, that's 10% of the sales. That sounds pretty reasonable. On the other hand, what if they'd invested, $500 billion and only got $10 billion of profit? Well, now that's sounding a whole lot less attractive, right? So from that standpoint, a number all by itself really doesn't give you a whole lot. The gross magnitude of the number may sound really impressive, but the reality is we need context to know whether or not they actually did a good job or not. So that brings us to the idea of a ratio. So a ratio is a relationship between two quantities. So we got, numerator and a denominator. And basically, that's going to help us kind of put things into context. So back to the example. So if they had $10 billion of profit on $100 billion worth of sales, that's 10%. So this is now a little bit more relatable. And now I can kind of compare that a little bit more across businesses of different sizes, for instance, and things like that, and get a better sense for, are they actually doing a better job of turning sales into profit or not? It's also important to note that sometimes you can get what could be termed sort of the right answer for kind of the wrong reasons. So let me give you an example of that. Generally speaking, we like it when companies make more money relative to the equity that shareholders invested. So in other words, we like a higher return on equity. So that sounds good, right? Well, it's possible to get a higher return on equity by just not having a lot of equity. So for instance, if a company borrows a tremendous amount of money and then they invest that and they only have a limited amount of shareholder investment, their return on equity can look really high, not because they're wildly profitable per se, but really because basically they just don't have many shareholders to spread the profit between, or at least not many shares. And so from that standpoint, it looks great, right? But the reason why that's sort of potentially kind of the wrong reason is in order to get there, this company had to borrow a tremendous amount of money and they did not have a lot of equity. Well, in the long run, that poses some risks. It's elevated risk of going bankrupt, for instance, right? So you have to look at kind of the context to determine whether or not the firm got the right answer for the right reasons or whether they got the sort of right answer for the wrong reasons. So that means that really when you're analyzing a firm's financial statements, really what you need to do is to try to consider that complete picture and how the pieces of the puzzle fit together. So don't just look at one little piece. Don't just look at the profitability piece, but also look at what's happening with the firm's assets, what's happening with their liabilities. Let's look at this full picture here as much as possible and see how they all fit together to tell us a story about how well the company is actually doing. Now, when you're looking at ratio analysis, you basically have kind of three broad types of kind of analysis here. So we've got cross-sectional analysis. This is going to be the ratios of your company or the company you're looking at compared to other companies in the same industry. So that's cross-sectional. So I'm comparing. So if I look at my company for this year and my competitor for this year, that's cross-sectional. A ratio trend analysis is looking at the ratios of a company over time. So if I look at the ratios of my company for this year, last year, 2 years ago, 3 years ago, and so forth, and I look at how those have progressed over time, that is a trend analysis. Now, if I have a cross-sectional trend analysis, that would be I look at my company and I look at my competitor or some other company in the industry for multiple years so I can see how things have been evolving over time for both the company of interest and, say, the competition, right? So in that case, it'd be cross-sectional because I would have my company and the other companies, or at least my company of interest and the other companies. And I would also have the trend because I have this over time, right? Now, there is another category here, and that is the intra-company analysis. Intra-company analysis is ratios of sections or divisions within a company. So if you're looking at a company that has multiple different divisions and you're doing ratio analysis for the different separate divisions and assessing those, that would be intra-company analysis. That's generally more difficult to do in practice unless you actually work for the company, because most of the time, at least in the United States, that data isn't really readily available. Most of the time, companies don't split out divisions, or at least not a tremendous amount of data by division. You might get some data, but oftentimes you don't get like a full set of, here's the amount of assets allocated to this division, here's the amount of profit that was received, here's the exact dollar amount of sales that was received, and so forth. Oftentimes you don't see that on a division by division level within a company in publicly released data. So more often than not, intracompany analysis would be something that you could do if you were working for the company and had access to the data. But the idea would be very similar in that we would look at those different segments or divisions or sections within the company and assess how well they were doing to try to determine perhaps, where should the company allocate more of its resources? Where are we making more money? What are some divisions that maybe we need to pare back or sell because they just aren't profitable for us? Okay, hopefully this little brief overview of types of ratio analysis and a few basic principles has been helpful. Thank you so much for watching and have a great day.